This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking Podcast with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternatives marketplace and explores topical issues. The podcast today is going to focus on the evergreen EIS funds, and we're delighted to have guests Mark Bower-Easton from Oxford Capital and Andrew Aldridge from Deepbridge. Welcome to you both.
Hi. Thank you.
Start with you, Mark.
Yeah, absolutely. So Oxford Capital, we've been a VC for 25 years now. Over the last 10 years, we have been focusing primarily on early stage tech businesses in sectors such as fintech, digital health, cybersecurity, and latterly getting into deep tech and AI investments. Myself, I've been at Oxford Capital for 4.5 years, and my role there is head of distribution, so focusing on fundraising, product development, marketing, and I also sit on the investment committee.
Brilliant. Okay, interesting sectors. And Andrew, can we get a bit of background on you?
Yes. Hi, Mel. Deepbridge Capital. We've been around 15 years. We are early stage tech and life sciences investors on EIS. So we have two separate funds, one for each. We've got about £300 million that we've deployed to date. And my role is I'm Chief Operations Officer. So I look after distribution, sales, marketing, operations, HR, all the fun stuff in a business.
Perfect. Okay. And so Steve.
Yes, so thank you both for joining us this morning. One of the things I want to touch on before we go into kind of the guts of the EIS evergreen funds, what they are, etc., is I guess when investors, advisors are looking at them, they're looking at multiple things, but a couple of the focuses are target returns and fees. And I know, Mark, you and I have spoken a few times on fees, and we work collaboratively with EISA to help them in terms of fee transparency so people can look at the breakdown of fees. Oxford Capital did a bit of an overhaul of their fee structure fairly recently. It's probably not that recent now, but do you want to talk us through, your approach to the fees, why you did the change of the fee structure?
Yeah, sure. So we changed our fee structure in January of 2024. Before that, we were very traditional. It was 2.5% initial fee, 2% AMC, and then a 20% performance fee at 100% hurdle, which was portfolio as a whole. Using partly consumer duty as inspiration when it comes to offering clients the value for money, offering them clarity on what the lifetime cost of an investment should be. We took the decision to basically evolve our fee structure from start to finish. So what we decided to do was introduce a tiered initial fee structure because we felt that someone investing £500,000 in our fund shouldn't be getting charged the same initial fee as someone investing £25,000 because it doesn't cost us any more to run that portfolio. So we introduced an initial tiered initial fee structure, starting at 5% for investments between 25 and 75,000, 4% 75 to 150, 3% 150 to 300, 2% 300 to 500, and 1% for 500,000 plus. We also restructured the way that fee was taken so that you no longer had to pay VAT on top.
Right.
We then had a look at the annual management fee, and we worked out, well, how much does this actually cost us to manage a portfolio? And so we looked to reduce our annual management fee from 2% plus VAT down to 1.25% plus VAT, and we also introduced a cap so that there were no longer any annual management fees to be paid after 7 years. So that gives the investor total clarity on how much they're going to pay over the lifetime of that investment. And then we went one step further and we reviewed our performance fee, and we decided that charging a performance fee just because you have returned that investor's initial capital isn't a particularly great look. So what we decided to do was increase that performance fee hurdle to 120%, with no catch-up or anything like that.
Yep.
It is just simply the performance fee on the excess of 120% return. And it's gone down very well with the market. We're getting some very large cases who are probably at the lower end of that tiered fee structure. It does take a little bit of explaining when someone's investing 25 to 75,000 because they think, blimey, 5% initial fee is quite punchy. But if you take an opportunity to explain to the investor and to the advisor and you focus on the total lifetime cost of the investment, it suddenly becomes a much more interesting proposition, even for those lower subscription amounts. To give you an example, lifetime cost for someone investing £25,000 is about 15.7%. That's about 9% lower than the market average.
Right.
So yeah, it's been good for us.
Yeah, and I think it's explaining to people, and when they look over the longer term, because these are long-term holdings, it's not looking at the initial cost, it's looking over a period of time, because that's what it's going to cost you over that period of time. And interesting. So just to go back on your fee structure, so that's aimed at the investor, so that impacts how much of their subscription actually gets deployed into funds and how much they are able to get tax relief on. Do you charge the investee companies at all?
So we charge the investee companies very occasionally, and that depends on whether we are leading around or co-leading around. Obviously, EIS is all that we do, and so if we're leading around, there's additional legal expenses, and so occasionally we will ask the portfolio company for a contribution towards that.
Those costs.
In our information memorandum, it says that we can charge up to 2%. The reality is that our average is about 0.6%.
Okay.
Good to know.
And so, Andrew, you're slightly different. I mean, just for our listeners, there tends to be, you either charge the investor or the alternative model is to charge the investee company.
Correct.
How does Deepbridge do theirs?
Yeah, great question. I think first and foremost, there's no hard and fast rule, and I think that is one of the great things in any kind of industry where you do have flexibility of how fees are charged, where they're charged, etc. And I think the work that Growth Investor have done to bring transparency to the market has been well received by the market, particularly by advisors. So I think that's, I'll say well done on that first and foremost. There you go. Bit of brown nosing to start with. There we go. But we've always taken the approach that we don't charge, on EIS, we don't charge the investor an initial or an AMC. We charge that to the investee companies. And that is after our team have had decades of experience working within venture capital and early stage fundraising. There is generally some sort of cost of capital. So if I was to go out and get a mortgage tomorrow, there'd be a cost of that capital, etc. So there's generally a cost involved when getting capital if you're a business, a private individual, etc. So that's kind of built in. So our mantra has always been, well, if we're charging that to the investee company, then we don't charge it to the investor as well. So the only fee that we would charge an investor on EIS is a performance fee, which again, as Mark said, is over 120% hurdle. So it's a slightly different model. And I think coming back, what Mark said about leading around, we always lead rounds on EIS. Right. That's kind of one of our positions in the market. So therefore, there are costs that come with that, and that is why we position that. So I think from that perspective, I think it is, there is no hard and fast rule. I think one of the considerations for advisors is when they are looking at EIS providers is to map out exactly what costs will look like over a lifetime. And I think it's great that other fund managers like Oxford Capital are helping advisors, as what Mark just said, kind of really outline from the outset exactly what it's going to cost. Because I think that is where, if you don't do that, that's where complexities lie and that's where issues lie. So I think it's really important from the outset the advisors and clients know exactly what the cost of their investment are going to be. Other models you see in the market, maybe rolling an AMC and then taking that on exit and things like that. Well, again, that's kind of an additional fee at the end. So, how can you model kind of what return profiles might look like, etc. So really understanding the fee model is important to help advisors understand return profiles over periods of times, etc. So again, anything that fund managers can do, whatever the model is, to help explain that from the outset is vitally important for advisors to understand.
Yes, makes a huge difference. I mean, we do fee illustrations, which now are highly popular, to be able to explain to clients exactly, what long-term outlook is on their fees.
And particularly, as Mark said, with consumer duty, I mean, it's imperative
Yes.
that cost is front and centre for advisors when they are looking at these things.
It's a part of the decision making for them, so they need to have clarity on what it is. And I think, you know, from the advisors we speak to, they appreciate the visibility that's there now. And I don't, you know, both of you, very different models in terms of your fees. Obviously, the performance piece is very, very similar, but there's no right or wrong rule to this. Yep. And what we see across the marketplace is there's some charge the company, some charge the investor, some charge both, and that's just the way it is. One of the pieces of feedback we've heard a couple of times is if you're charging the company, is that preventing you accessing some of the better deals? And obviously I'm going to come to you on that one, just given that's your model there. So what's your kind of view on that?
I think probably in the 10, 12 years kind of that I've been involved with Deepbridge and fundraising and working, you know, helping get deal flow for companies, I would say probably in that time we've probably lost 2 deals because on fees. Yeah. And again, fees probably wasn't the major reason why those deals didn't go ahead. It was probably just one of the contributing factors. So it's very rare that becomes a factor. Yeah. And I think what the maturity of the EIS market and the venture capital market in the UK now means that actually there's a lot more signposting of where people who are looking to fundraise should be going. Mm-hmm. So I appreciate this podcast is aimed at advisors predominantly, but on the other side of the fence that we deal with, where we're looking at deal flow and we're looking at how we attract companies to the business, the more signposting that goes on within that side of the business, the more that you're likely to see deals that fit your model. Yeah. So, for example, if somebody came to us and they were just purely looking interested in a passive investor that was going to, you know, just give them the cash and then not touch them for a few years and let them go off and do anything, that's not our model. Mm-hmm. We are very much active, hands-on managers, hence why we believe that we bring value to what we're doing. So again, we don't tend to see those deals where they just want passive capital. Right. Yeah. They tend to go to other managers or other routes to capital that probably aren't going to be approaching us. So it's those kind of things as well. So it's not kind of a hard and fast. It's not kind of you know, that price elasticity isn't there because you know, actually where we sit, we tend to see the deals that we are right for as a funder and the partner rather than just capital.
Interesting. Mark, any views on that?
Yeah, I mean, I've had numerous conversations with multiple advisors and investors and other VCs about what is the best fee structure for the investor, for the portfolio company. And I think that if you are charging a portfolio company a fee, I think there are some VCs who just charge the fee because it's a relatively cynical way of raising capital for investors. You know, if you say to an advisor or a client, here's an EIS fund and it's going to cost you 5% to go in, or here's another EIS fund and it's not going to cost you a penny, then which one will you go for? I think there are companies like Andrew's where, you know, they do add a lot of value to those portfolio companies. And so if you can justify the fact that you are going to be giving them more than just financial backing, then absolutely, you know, they should be ripping your arm off to get your money and shouldn't be unhappy to pay that fee. Yeah, from our perspective, you know, our view is that as an evergreen fund, as an investment-led VC, you know, we really want to make sure that as much of the fundraising going into these businesses is used by the portfolio company. We don't really want to say, here's, you know, £500,000 and we're going to take £50,000 back, because at the end of the day, our sole goal is to grow these businesses, to get them profitable and hopefully achieve a successful exit further down the line.
Now that brings us nicely on to exits, because one thing we've really focused on our sort of series of podcasts has been liquidity across, you know, the alternative marketplace. And we know that there's been, particularly in EIS, over the last few years, I mean, obviously we've had a lot going on in the world, but patient capital, yes, but people sort of expected maybe 5 to 7 years to start seeing exits. And we know that some EIS funds are now sort of looking 10, 12 years. What's your views on liquidity? There's a lot coming into the marketplace. There's talks of PICEs came out in the spring budget as well. So there's a lot we can chat through here. What's your sort of views on the liquidity and where you can see things going?
Yeah, I think liquidity naturally since the patient capital review back in 2017, and you've taken away the kind of the old asset-backed EISs, which were 3 years and a day, and you might get back 90p in the pound or a pound, but you've had your tax reliefs, and everyone moves away happy. Since patient capital review, which is coming, it's 8 years ago, we have seen a change in the market, obviously, because going into organic companies that are seeking to grow, there is a natural patience that you have to have with that. An absolute pun intended. So we've seen the market get used to that, and I think for advisors and investors, it has been a change of mindset over the last 5 to kind of 7 years to kind of get their head around that actually maybe what they did 10 years ago isn't the same anymore. I think we've also had, global challenges. You had COVID, for example. So, for example, some of our med tech companies, they were not able to get into hospitals to do trials or testing or rolling out products for nearly 3 years. This wasn't, the world went back to normal in 2021, but actually in the NHS and healthcare systems around the world, there was a delay where you couldn't get back in to do things. So naturally, that hasn't had a knock-on effect. You've then had all the inflationary pressures since Ukraine and Russia, etc. So all these kind of things have meant there's been knock-on effects globally which have impacted down to the VC level. And I think one of the biggest things over the last couple of years has been the lack of private equity coming in at a later stage. So if our companies might do 3 to 5 million under EIS, at some point, if they are highly scientific, they're probably going to need a 10 to 20 million pound check at some point to get them through to that exit point. And that cash really hasn't been there over the last couple of years, or it's been a lot harder to source. We're starting to see green shoots now. We're starting to see things come back through. So I really do think the next 12, 18 months
is quite exciting.
It's really exciting. And I think for investors getting into EIS over the last couple of years, I think they are going to see a really
And we're seeing exits come into the marketplace,
Correct,
aren't we? There's been quite a few being announced recently.
Correct. And Oxford Capital and ourselves have both had exits in the last kind of 6, 12 months. And we're working on several at the moment. So again, I think that's definitely what we're seeing. What about you, Mark? Is that...
Yeah, absolutely. I mean, I think that IPOs, which historically have formed a minority part of EIS exits, they're pretty much dead at the moment. I think
few coming.
A few coming
onto AIM.
A few coming, but we'll see how they go.
Yes.
The proof's in the pudding.
Yeah. Trade sales. I mean, we had one trade sale exit in July of 2024. It was, I think that generated about a 3x return for us. So it was fine, but not, particularly spectacular. I think one thing that we have been using quite a lot over the last couple of years is the secondary market.
Right.
It really interesting this, because I noticed in the IM as well, you reference the secondary market and how it's evolved. So be really keen to hear what your views are there.
Yeah, I think, we're investing the money of retail investors. And I know patient capital is a buzzword, but there's only a finite amount of patience when it comes to investors. And if your information memorandum says that you're going to be investing for 5 to 7 years, then you need to start returning capital back to investors one way or another. Like, it's great having a biannual statement with a paper valuation that looks amazing, but it doesn't mean anything until the money is back in their account. So we're always actively looking for secondary opportunities if it makes sense for our investors.
And what would you classify as secondary then? Just to explain it for some of the listeners who won't necessarily understand exactly what that is.
Yeah, sure. So the way that we operate with secondaries is when we work with our portfolio companies and we find that they are maybe doing a new funding round, a much larger valuation, and there's maybe a new institutional investor coming in who want to be added to the cap table. We did that with a digital security company called Redsift in 2022. It was Highland Europe who came in. They wanted to get onto the cap table, and that returned us, I think, about 9.5x back.
So they actually come in and buy some of your existing shares that you hold on behalf of your clients.
Exactly that. And then latterly, we had a partial exit from Moneybox. And that was that came around because Apis and Amundi wanted to invest £70 million into Moneybox. So we sold part of our shareholding, about 20% of it. A couple of other companies on the cap table sold it as well to take it up to the full 70 million, and that returned 17x back to our seed stage investors, 12x back to our Series A, and 6x back to our Series B. And we still have about 75% of our shareholding there or thereabouts, because we think it's a company that's got a long way to go in terms of its growth cycle.
I think, I think absolutely, as Mark said, I think secondaries are becoming increasingly important because of the time scale that it takes to fully grow a company, if you like. So again, if we're talking medical technologies or really scientific, quantum computing or these really kind of scientific heavy lifting kind of things that EIS can do, you might be looking 10, 12, 15 years before they get to a position where they are going to go for mega bucks and a big valuation. But along that journey, like I said before, they might need 10, 20 million pound checks. So if you can use that to also, one of the benefits for a founder in a business as well is that can mean that actually they can clean up their cap table as well to some degree. So again, if we've got in at SEIS and EIS, we can end up having quite a large chunk of that business, which actually we don't really want in the best manner, because you'd want to keep incentive for the founders and the people running that business.
Keep things moving.
So when you get to a certain point where they are bringing in large scale capital to clean up, yes, as Mark said, it's great to keep a small percentage of what we're doing in that business or a good chunk, but actually selling off some of what you've got, some of your early investors, is good for the founder as well as the investors. So it's those kind of considerations that we kind of take on board when we're looking at deals. Yeah,
and also with the lack of liquidity in the market over the last 3 or 4 years, it's really important that you do return some sort of cash back to investors, because it enables them to recycle the cash into new EIS, into new investments. I think sophisticated investors typically do this, and they will have a mandate either in their head or written down, and they will say, right, 30% or 20% of my capital is going to go into this. And if they are at that point and there's no exits coming, what's the point of having a mandate if you just throw more money at it? You need money out in order to go again.
It was interesting you made the comment there about the first exit where you said it was 3x and it wasn't particularly exciting, but if you think about it from the investor perspective, they're probably very happy with the 3x. Because again, it comes out to that point, they want the liquidity, they want to be able to recycle that investment again, theoretically.
Absolutely.
And I guess that's the one of the difficulties you guys as managers face is where could you get to with these companies versus the reality of what does an investor want, and it's trying to balance that, I guess, is the difficult part.
Completely, and again, that comes back to Mark's point about keeping some of our capital in, and maybe taking some off the table. And there's different models of doing it. In some cases, you might get an offer on the table, and actually, you ask clients, do they want to exit some of their capital or not? Whereas some, you might actually have to state, okay, this tranche is exiting, etc. So again, there's different models even when you kind of get to those kind of conversations, and it's just trying to work out where that fits between interest in the long term, but also shorter term interest for investors who do want to see that cash recycled.
Yeah, 100%.
I mean, it goes back as well, like when we were talking about the patient capital review. I mean, you do hope now with the world becoming a slightly, possibly a bit more, secure economics, and we might.
Where have you got that from?
But if we could get to a position with exciting sectors like you're moving into AI as well, there's a lot of areas where the growth could come through, and if we could have liquidity events that mean people can move through the kind of patient capital cycle, but still, run with them right till, the end, it becomes a very interesting marketplace, doesn't it? And when capital markets are under pressure, you can see the sort of wave for semi-liquids and the EIS funds, can't you? Moving on to capital markets and what we heard in the spring budget, there was talk, Pisces. We've got Marcus coming on in a couple of weeks to sort of really talk more about Pisces. But we know that there's going to be the London Stock Exchange, their offering for secondaries, but also we know JP Jenkins, there's a number. What do you feel this is an area where you could see potential liquidity and exits coming?
I think there's still a lot to be understood about what PICE is,
yeah.
how it's going to work, how it is going to be overseen from a clarity and a transparency perspective. You know, how are we going to make sure consistency across how people are reporting and what they're doing, etc. All those kind of things. In principle, absolutely. You know, we've the issue that we have in the UK now has kind of moved up the food chain. So EIS has been around for 30 years. You know, EIS came in to solve a problem of early stage funding and that kind of grassroots level for founders, etc. And over the years has evolved, etc. And what we've got is in the UK, we've got a phenomenal ecosystem for startups and early stage scale-ups. What we lack at the moment is that next stage of funding to help companies grow, which is why we do see this kind of brain drain of companies going to the US or wherever to go and get that funding. So anything we can do to now kind of solve that next link in the chain and going up has got to be extremely positive for us, because we've got great academia, we've got great startups, we've got great entrepreneurial spirit, we've got great ecosystems, we've got great grant funding at the early stage for startups as well. We've got EIS that plays a fantastic and pivotal role in that world, and it's that next stage of actually how do we kind of provide extra funding going forward. And secondaries, is the conversation we've had completely this morning, is where EIS needs to get to make sure that investors and advisors keep coming back to EIS, is having that liquidity. And without that, there is a risk that if people just see their cash going into EIS companies and not seeing it for 10, 15 years, then that kind of capital will start going backwards as well. So it's hugely important. So it'd be great to see what PICE actually looks like when we get there. But any ideas and kind of are welcome, I guess.
Yeah, I think May 2025 is when we're going to see a lot more meat on the bone. So, we're kind of speculating at the moment. I think my one concern about this is primarily around institutional investors. Are they going to be using PICEs to benefit the investors, or are they going to be using PICEs to benefit themselves?
Yeah.
It's going to be very, very, very easy to put some shares on PICEs, and, a VC could say, well, we're going to do this because, we want a performance fee.
Yeah.
But does it necessarily mean that it's in the best interests of the client to sell right then, there for that price? So I think there needs to be a little bit of thought around that to prevent that sort of thing happening. Maybe a minimum holding period before an institution can put shares on PICEs, something like that. We'll see. But it in theory it's great. In practice, wait and see
how it works.
Look into the detail.
Yeah. And I think it's been interesting over the last kind of 6-12 months. We've certainly seen, talking to institutional funders, family offices, etc., more and more they are now looking at secondaries because they are seeing value in secondaries. Whereas a lot of them will quite openly admit that even 12, 18, 24 months ago, they never looked at secondaries. They only looked at primary capital. So we're starting to see that market come through. Now, is that partly because PICE has been talked about and they're starting to prepare for it, or is that just the natural flow of the market? So all those things, I think, are an interesting take on the market where it sits. So, it is timely. I think it is appropriate, and it will help solve problems. But as Mark said, there is always going to be that conflict of who's actually benefiting from this. And again, that's what managers such as ourselves, advisors, investors, angel investors, are all going to have to look at as part of the considerations as they go forward.
And you both touched on, I guess, the fact that the IPO arena has been very, very quiet of late, and we know that, and we've seen a lot of brain drain, as you said, going across the pond. I don't know whether either of you saw at the weekend, there was a great article in the Sunday Times Business yesterday about IPOs, and saying some of the benefits that the US exchanges are offering over and above the listing to get companies to list over there. I was quite blown away by the packages they were offering on top, but it was actually quite positive towards LSE as well. And I guess that's the key, I think, isn't it? Is we've got to make our marketplaces more attractive. PICEs kind of fills in a little bit of a gap, but we need to get companies wanting to list on AIM. We need to get companies really wanting to list on LSE as well. What do you think we can be doing in that side to kind of make us more attractive?
Gosh,
how do you fix the system?
I mean, I think I think IPO regulation has been far too robust for quite a long period of time. I think the rules around IPOs need to be loosened quite significantly. I know that the FCA are looking into ways to reduced IPO kind of bureaucracy. But I don't think it's just driven by the FCA. I think the Conservative government made a few interesting choices over the last sort of 14 years or so, which perhaps didn't benefit the London Stock Exchange. But yeah, I think, like you said earlier, that there are a few IPOs kind of coming along. The proof is going to be in the pudding, though.
Yes, how they fare.
And it's great, floating for a certain price, but what is that price in 6 months' time?
Well,
that's what we need to see. We need to see that there's a track record, that there are companies who float and don't tank.
Correct.
Yeah.
That stickiness.
Because this is what they reference in the article. There's 20 companies that have listed, UK companies that have then gone to the US to raise funds, and of those that have raised 100 million, I think there was 4 are now trading higher.
Yeah.
It was 7 or 9 have now delisted, and the rest are trading lower. So the grass isn't always greener anyway. It may look good day one because there's a bigger capacity for fundraising, but is it the holy grail?
I had a conversation with one of our investors probably 6 months or so ago now. We had a company who, up until, well, probably still does think this actually, about 3 years ago was thinking about exiting via an IPO. And I said to this investor, like, if there was a trade sale and it sold for £1 billion, let's say, and it IPO'd for 1.3 billion, and potentially in 6 months it could go up to 1.6 or it could drop to 700.
Yeah.
Which one would you go for? And he said, trade sale.
Trade sale. Yeah.
Every day of the week.
Yeah.
One in the hand, worth 2 in the bush.
Yes.
And all of that. There you go.
And it's risky, isn't it? Because you've invested in multiple rounds across 5, 6, 7 years in this company, and then you are unleashing it on the market.
Yeah.
And, it could tank based on factors so far out of your control.
Yes, just on market sentiment.
Yeah.
Yeah.
I think we've got to, I think in the UK, we've got to recognise that we are still suffering a hangover since Brexit.
Yep.
That is why it's an influencing factor on why there has been less IPOs in the UK. So I think there's also been huge political instability in the UK. The Tory party changing their prime minister every kind of 18 months didn't help. So all those kind of things that, again, as Mark said, outside of the investor's control, have led us to this position where we are at the moment, where London isn't the sexiest place in the world to do an IPO if you're considering it. We've got 3 companies in our portfolio that are all currently working towards IPOs and considering IPOs.
In the UK?
No, they're all in the US.
In the
all
US.
in the US.
What sectors are they from the life sciences? Or
they are med tech, and e-commerce tech, and kind of another, not med tech, but in that kind of market. I'm trying to say things so that people don't go, that's the company you're talking about. But they are looking now. In reality, we expect a trade sale will probably come in before they get to an IPO. But we're actually starting to plan out now, because an IPO takes, in reality, 2 years to get away at minimum. So, we're starting already. We're about 3-6 months in with most of these companies. So you're looking probably late 2026 at the earliest for an IPO. Now, we think there could be trade sale opportunities before that. But rather than waiting for that to happen, we're working in parallel. Now, why did the US like UK tech companies? All the things we mentioned before, academia, the skill sets over here. If they are recruiting, then there's great skills over here. But also, the UK is cheap. If you came
up in a recent podcast we did with Callum Pickering, wasn't it?
So,
and we were saying, that could be quite a big catalyst to get things moving over here, that the UK is seen as undervalued.
But US like to take companies to the US to list them because they're more comfortable with that. So again, you've got to see where we sit in the market. If you've got a tech developer and you're hiring in the West Coast of America, their starting salary could easily be $250,000 a year. Over here, you could be looking at £45,000 to £50,000. So the value that they're seeing over here is phenomenal, which is why they're looking to attract them. But they're much more comfortable if it's listed in the US than it would be in London. So therefore, all these kind of things. Whereas actually, if you're looking at then at funding coming in from Europe, actually the UK looks expensive.
Yes.
Because those tech developers would be even cheaper in Spain or
Yes.
Italy, etc. So it's understanding the global market where we sit as well as to why there's these drivers to where people will IPO. And I think it's all those kind of considerations that we have to look at with our portfolio to understand where the best place or the best source of capital is for them going forward. So it's not just London needs to get its act together. It is. It's much wider than that, and it's that understanding the context globally. But we're definitely seeing green shoots and definitely seeing a lot of interest, particularly of overseas capital now starting to once again look at UK kind of early stage businesses because they can see the value that's here.
Yeah. And I'm just sort of, as we sort of start to wrap up, we're obviously coming to the end of the tax season. And what are your thoughts, EIS, going forward? I mean, from my perspective, advisors are, I think the season's not been as strong as possibly, previous years. But I think there is a feeling that with the new inheritance tax regulations, it might become quite a big focus over the next year. Is that your sort of feedback?
Yeah, I mean, I think the autumn statement had some really positive aspects for the enterprise investment scheme, maybe less so for the wider society. But for EIS providers, it was quite interesting. I think the treatment of AIM shares, for example, which historically have been quite an interesting way of mitigating inheritance tax, pensions that have historically been an interesting way of mitigating IHT. We've both received a lot of inquiries with people who have used those particular schemes to plan their IHT, their estate. So we're getting a lot of people who are saying, look, the government have ruined my IHT planning with my pension. I want to give you X amount of money over the next 5 years. I think that EIS, it didn't escape, totally.
No.
Only the first £1 million now that qualifies fully for business relief, but only having a 20% tax rate as opposed to 40 on the excess is it's a pretty good compromise for us. So I think we're in a pretty strong position.
Yeah, I think tax-efficient investments as a whole are definitely got to be front and centre for advisors. Advisors, a lot of advisors, really good advisors, are having to unpick certain things they've done over the last maybe 15, 20 years with clients because they've done exactly the right things over time, but now the goalposts have moved. So actually, EIS to extract capital from other sources can be hugely powerful, and then business relief propositions, etc. on the back of that. So if advisors are maybe anybody listening to this through Growth Invest hopefully is switched on to tax-efficient investments.
Yes.
But let's say there have been some more archaic advisors out there who have just gone, no, don't touch those kind of things and those products. And I think those advisors are really going to struggle. So advisors that are switched on, looking at new opportunities, understand this market. I think the budget changes for them as a business actually means opportunities. And I think that's the thing that advisors have got to look at it now as an opportunity to get back in front of some of their clients, redo some of their tax planning, sit down, go through everything. And EIS, business relief, etc. is going to be critical as they go forward. So I think we'll certainly see that coming forward to the fore over the next 12 months.
And I think even though we're right at the end of the tax year now, it's a great opportunity now for advisors to sit down with their clients and actually add some really good value to them because of the changes and, talk them through it.
And EIS shouldn't just be a tax year end thing.
No, exactly.
We historically as an industry, we've talked about tax year end as being this critical junction. Actually, advisors, this should be part of their annual review with clients all through the year. There's great funds out there, great opportunities, and they should be doing this routinely as part of what they're doing, rather than just getting to March and going panic
now
stations.
We need
what
to,
do we need to do
for the carryback, etc., etc. Yeah, no, 100%. Brilliant.
Well, I think that's a great way to wrap up. Thank you both so much. It's been brilliant. And well, hopefully we'll wait and see what this season's going to numbers are. But strong one for next year.
Brilliant.
Perfect.
Thank you both for your time.
Very much.
Thank you.
Thank you.
To hear more, tune in to either YouTube on video or all good podcast channels.